Earnings week continues and we are focusing on Shopify, who just reported, and we can see in the pre-market they are down 19%. So we're going to take a look at why this company has been crushed after their fairly strong earnings. We're going to take a look at this company, see where their top line revenue growth is coming from, as well as their bottom line net income. We're going to do our usual analysis on the balance sheet, a quick health check, total cash versus total debt. We're also going to take a look at their investor presentation that they just released minutes ago to pull out some very important information. And as always, we will look at both insider buys as well as institutions to see if they are continuing to buy this growth company. And as always, we'll look at the underlying financial metrics, the free cash flow growth, the sales growth, the ROIC, as well as many others. And don't forget, we will run them through the valuation model, getting to both our intrinsic value, our acceptable buy price, given that investor margin of safety, and also look at Wall Street to see what they're targeting for a price over the next 12 months. And in today's episode, we will take a look at 3 different growth rates within the discounted cash flow model so you can understand where these price targets are coming from. So firstly, let's have a quick look at the historical performance. Now, we do note it will be trending lower towards the mid to lower end once the market does open, and the forward P that does sit very high at 75 will come crashing down, as we can see, down 20%. We do also see 1 buy rating from Wall Street, as well as 1 hold from Seeking Alpha and 1 hold from Quant Analyst. And we note it is up around 20% over the last 12 months, but a lot of those gains will now be given back to the market once it does open. And we can see over the last 5 years, whilst it is up around 198%, we do in fact note it is some way away from its all-time highs, sitting around $170 nearly 3 years ago. When we take a look at their earnings, we can see the top line does review that their revenue is in line with the expectations, but the stock does drop around 16.7%. As we said, it continues to fall. So let's take a look at the numbers. What were the issues, and if there's anything that we can spot that does indicate this may not be strongly undervalued. So firstly, their revenue came in 1.86 billion. Although a marginal beat, still beating analyst targets of 1.85 billion. When we take a look at earnings per share, 20 cents, again beating analyst targets of 17. Gross margin looking very strong, 51.4, up from 47.5 from the same quarter last year. Now, we do note here the free cash flow is down, so it's 232 million, and we can see just from the previous quarter down 48%, so that is a very large amount. Now, both in terms of the gross merchandise volume and payments volume, they are up year on year, 23% and 60% respectively. So the only negative we can see now is in fact the free cash flow is down significantly from the previous quarter, so we will consider that when we do look at their investor presentation as well. In terms of looking at their growth on the top line, typically 3 to 7% year on year as a baseline, but this is a growth company, so we do expect larger numbers. They reported 105 million in December 2014. Latest annual report, 7.1 billion. So that is some very rapid growth. And when we do take a look at it on a graph level, that is very impressive to see. And we can understand why it does have a very high forward P. Nonetheless, we do need to dig deeper to understand whether or not this is warranted and justified. On the bottom line, how does that compare? Well, in fact, the first thing we note, the majority of the last 10 years, and we can see even from the graph, has in fact been negative, so they have been loss-making. We note for profit-making 2020, 2021, and 2023. So that is definitely something to consider. Yes, maybe a growth company won't turn a profit that soon, but still something we need to understand, as likely we want to see a net income very soon and consistently after December 2023. So we already have the first thing we should question within our own investment thesis. The second point here is looking at the health of the company, total cash versus total debt. They have around 60 million of cash and short-term investments in 2014, just over 5 billion from that latest report. So they are holding more and more cash over the longer term. Now, that isn't necessarily indicator of anything, but what we do now is compare it both numerically and directionally to their total debt. What we can see when we look at that, in fact, it was sitting at 0 in 2014 and around 1.1 billion in their latest quarterly report. Now, even though their total debt has increased over the longer term, what we would say is their total cash balance is much higher than their total debt. So the balance sheet overall on a high level review does look fairly strong, and that net debt to EBITDA metric we will look at later should also back that up. Now, in terms of their earnings, this is their earnings versus the analyst targets. One thing we do note, a very good trend to have over the last 4 quarters. They have in fact beaten analyst targets, so they have a very good track record. Forward looking, there is the expectation of some very strong growth in terms of the earnings per share on a year-on-year basis. We are seeing double digits. However, I would say this is expected given the fact this is a company that is trading at a very high forward PE. Now, talking of valuation, we're going to take a look at the grade, and straight away we can see a very poor grade at F. Now, the reason this is when we look at it in comparison to the sector median, we can see here that 74.9 that we discussed earlier, a PE forward on a non-GAAP basis. The sector median does trade a lot lower at 23.82. Now, there are other metrics here to take a look at. That is the one we do want to point out. But the expectation when we do now take a look at growth is that it will be warranted, as we should now see very high growth. And we do get growth grade of A+, so the highest grade obtainable. Now, nothing too essentially striking. We do see revenue growth year on year up 26%. Sector median a lot lower at 3%. On a forward looking, continuing that double digit growth trend, 22.6 with the sector at 6.91. There are other also metrics, as we can see the EBITDA as well as the earnings per share. In fact, the earnings per share on a diluted basis is anticipated to grow by triple digits. And when we look at the earnings per share over the next 3 to 5 years, annually, that compounded annual growth rate for the earnings is around 49%, as we can see here, the sector median at 13.72. So yes, growth looking very impressive, and we will circle back later when we do look at the valuation model to understand the numbers behind whether or not this should be justified at the price. So let's take a look at the profitability. Now, they do get a B rating. First thing first, gross profit margin 49.8%. We do see it not too far off the sector median. And when we do take a look at that net income margin, 1.87%, slightly lower than the sector median. So in terms of actual margins, both gross and net, they aren't too far off what the sector is producing. Cash from operations getting an A grade, as we can see, very strong, 944 million versus the sector of 89.7. So a lot of metrics that do look very strong. So let's continue. The first thing that I do want to say, so in terms of insider buys and insider sells, we can see there is no recent insider track record for Shopify, so we don't have much to say. Granted, we do have some movements by US Congress members, both sells and buys, that this isn't typically what we do factor into our own investment analysis. Whether it was insiders, it would play a bigger part. When we take a look at institutional ownership, just under 70%, we see 5.44 billion worth of buys by the institutions over the last 12 months. However, during the same period, we do note a little bit more selling. So not just, in fact, over the last 12 months, but we also note here in Q1 2024, institutions have been selling more shares of Shopify than they have been buying. Again, whether or not you want to factor that in even into your margin of safety, do also do your own due diligence and never copy what these institutions or insiders do. So let's take a look at their latest investor presentation, again, just from early morning today. The first thing we wanted to point out, as we can see, their revenue for the quarter, 1.9 billion. It is up 23% year on year. So that is a very positive sign. And as we saw earlier, their growth grade does get a very high rating. We do also note some other metrics here, but nothing we will be taking forward into our analysis. Second thing that we just want to point out, as we mentioned earlier, their growth has been phenomenal over the last few years, and we can see their gross profit has grown tremendously, as well as their adjusted operating income, and likewise their free cash flow margin, which we will discuss shortly as well, has increased very strongly. And in fact, talking about free cash flow margin, we do note 12% in quarter one of 2024, 6% from the same quarter last year, and it's very positive to note that we can now see 3 consecutive years of double digits in terms of the margin, and that is very impressive. We're going to come across onto why that is as well shortly, that you do want to be investing in companies that are free cash flow machines and that are a minimum at that 5 to 7% level. So nice to note over the last 3 quarters, we are seeing double digits. So before we jump into the metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, instant access, do click on that pinned comment below. We do want to draw your attention to how to find undervalued stocks. The reason for this, we get a lot of comments asking what are the websites we use, all explained in here. The list, if you want to have a look yourself, is also included. As I just mentioned, with free cash flow, you want to be investing in companies that increase over the longer term. Now, we do know they have struggled in the earlier period, as we can clearly see here, but from 2020, it has been increasing over the longer term, excluding 2022. 2023 at 0.71, 2024 expected to go higher, and as we saw, that free cash flow margin is also increasing, so a very positive sign. In terms of sales growth, now this is one of the reasons why you could argue the valuation is very high. Their growth is very strong in terms of the top line. In fact, we had triple digits in 2014, but we notice a trend. It is decreasing. The question now remains, can they keep up with this growth moving forward, or will we start to see it slip down into single digits? For now, quarter on quarter, year on year, we do see the double digits increase to their revenue, but again, a question you need to think about. And we can see another format to what we discussed earlier, very, very sharp increases to their total revenue. Shares outstanding, very common. We do want to see companies do share buybacks, returning excess cash to investor pockets. What we note here, the opposite. In fact, they would have diluted your position over the longer term. We can actually see shares outstanding has increased, although we note over the last few years, it hasn't moved too much. ROIC, now as we always say, it is one of our 7 golden dividend metrics, which we talk about in one of our articles on the free weekly newsletters. We want 10% or more just to give us faith that management are able to effectively allocate their capital. However, no surprises here, given they have made a loss for the majority of the last 10 years, hence why this is negative. We do see 3% in 2023, but as we just mentioned, ideally we want to see that double-digit number. Operating margin, again, no surprises why we are seeing negative here. They haven't made a profit, but again, 2023 at 4%. We do want to see this company, when it does move out of the growth phase, into the strong double digits. And free cash flow margin, as we just touched upon, if they can continue their strong double-digit numbers, then it will be very positive and attractive to investors as well as potential investors. Now, net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. This shows us 2 things. 1, essentially the balance sheet strength of the company, and 2, the overall health. What we can see, 000, what this indicates, it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. And what we have noticed when we looked at their balance sheet, we saw a similar thing there as well. Cash balance very, very large in comparison to their total debt. So as always, let's now jump into the valuation model. And if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the only model that is relevant for today's episode is the discounted cash flow model. However, on our analysis every single day, we run through 4 different models on the majority of stocks. As we mentioned, for Shopify, only relevant today, the DCF. So we have the free cash flow year on year. Now, we can see the average growth rate pretty high, but it is a bit skewed from the negative to positive. Now, moving forwards, we have gone for 3 different rates. So the first one is a low growth rate at 20%. As we can see, with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, and get to the equity value, divide by the shares outstanding. And we can see here an intrinsic value with an overvaluation sign. So if you believe 20% is applicable, then the implied downside is negative 21%. If you're someone who believes it should be higher, at 25%, we run the numbers again, and we get an intrinsic value of $67, implying some upside, and as we can see here, exactly sitting at 9%. For those who believe this will continue to grow at a very rapid rate, at 30%, we can see undervaluation, and the implied upside would be around 49%. Now, as always, you can click on the pinned comment below, grab a copy of this model. It includes all 4 models, run your own numbers through, whether it's for Shopify or others on your watch list or in the portfolio. In today's episode, we're going to stick with the medium to take it through to the next slide. So at 25%, the intrinsic value then in today's episode is just the DCF model. Remember, if we do other stocks and include other models, it will just be the average of those. So $67.32. Now the current stock sits at around $62. And what we can see here today is that we would use a margin of safety of 10%. Remember, we only execute on stocks if it meets our 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So what we'd say for Shopify in today's episode, it isn't too far off being at a 10% MOS level. For those who would look at 15%, it would be by around $57. At 20%, it would be around $54. But as we said, for today's episode, it is near that 10%. Do bear in mind though that these numbers are being pulled on a growth rate basis of 25%. If it was higher or lower, these numbers would be different. So in terms of Wall Street and their expectations, well, they see a price target of $83 or just under, with implied upside of 34% over the next 12 months. But as always, let us know your thoughts in the comments below. Is Shopify maybe one that you're looking to buy? Is it one on the watch list? Or for whatever reason, maybe it isn't one that does interest you. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and let us know your thoughts below, and we'll see you all on the next one.